Hello, everyone. This is John Salas from Real Estate Realty. Thank you again for joining us for another episode here on our Move Smartly YouTube channel. In today's show, I wanted to take a look at Canada's economy to get a sense and some insight into the broader macroeconomic trends that might impact Canada's housing market in the months ahead. And we're going to cover a lot of topics in this discussion, including how Canada's booming population is masking what's really happening on the ground in the economy, why the Bank of Canada is likely done raising rates in this cycle, why the Bank of Canada may not cut rates even if Canada enters into a recession, and how high interest rates might impact Canada's housing market in the months and years ahead. Now, to navigate all of these complex issues, I've invited Bank of Montreal senior economist and director of economics, Robert Kavcic, to join us again here at Move Smartly. Robert's been at the Bank of Montreal since 2006, and before that, worked in the Bank of Canada's research department. One of Robert's key roles at BMO is analyzing real estate trends, and he's one economist personally who I enjoy reading because he has a very good sense of not just the sort of the macroeconomic picture impacting housing, but a very good idea of what's going on the ground in the housing market. Now, if you have any questions for me specifically, you can send me any emails or feedback at askjohn@movesmartly.com. And now on to today's episode. All right, Robert, thanks so much for joining us today on our Move Smartly YouTube channel and podcast. It's about, I think, maybe around 6 months since we last connected. So I thought it'd be a good time to maybe just regroup on the economy, where Canada's at, what has changed. So maybe we can just kind of kick off with that. How has our economy kind of evolved, say, in the past 6 months? It feels like things are different. Kind of what are the numbers looking like in Canada's economy right now?
Yeah, I'd say things have really softened in the last 6 months. So, go back to the start of the year. A lot of people were expecting a recession. Markets were kind of pricing in weakness. There was a lot of talk and chatter about rate cuts in the second half of the year because the economy was going to break, and the economy never really broke. Um, but what we're seeing on the ground now is there's some signs now that 475 basis points of rate hikes are starting to bite as we would have expected. So, I mean, just like really, really roughly, if you look at things like the number of job vacancies in Canada, we're not seeing a lot of unemployment, but job vacancies are really coming down. So that's a sign that some of the excess demand in the labor market is getting worked off. Even the GDP numbers, like we get monthly GDP numbers in Canada, we've gone 7 months now with no real economic growth.
Mm-hmm.
And that in itself is something, but when you set that against like 3% population growth, that starts to look, really not that great. So, in real per capita terms, we've been contracting for pretty much the last 6 or 7 months.
That's actually a good point, and maybe you can unpack that for us for the average person, sort of what you mean by per capita terms, and why that matters in the context of, like you said, 3% population growth. Because we've been seeing some people talk about, I mean, the Bank of Canada, I think, in their monetary policy report was talking about negative GDP per capita. So maybe if you can unpack kind of the difference.
Yeah, sure. So when we're forecasting it, and when agencies are marking recessions, when the Bank of Canada is forecasting GDP, they're looking at the aggregate output of the economy, right? So right now, in aggregate, the economy over the last 6 months has basically gone sideways in inflation adjusted terms. So we're not producing any more, we're not producing any less. But in per capita terms, obviously, we're all aware that we're seeing historic population flows, and our populations are growing at about 3% per year. So on a per person basis, we are producing less. And so in per capita terms, we are like effectively the wealth or the production of every individual Canadian has been falling for the last 6 or 7 months. So another example of this is if you look at something like, let's say, retail sales. Retail sales are growing year over year, but the population is up 3%.
Mm-hmm.
Inflation is 4 or 5%. So really, at the end of the day, like in practical terms, you have more and more people spending more and more money on the same or less amount of stuff, if you know what I mean. So per capita spending is actually falling in terms of the volume of goods we're able to buy.
Okay.
So it probably is starting to feel tougher, like for an individual household or for an individual person in the economy than the aggregate numbers overall would suggest.
Yeah. So, I mean, that's a great point, I think, for viewers, this idea that, I mean, if your population is growing by 3%, you're obviously going to have more people spending money. But it's the per capita numbers that are low. So that are important to look at. Now, do you think it's more important to look at GDP per capita in Canada's case rather than just the aggregate? And does it give us a better picture of kind of where we're heading?
Yeah, like so for policy, it's like the aggregate matters because the Bank of Canada is looking at the output gap, right, and how much we can produce versus how much we supply, and that drives inflation. But in practical terms, yeah, per capita growth and per capita income matter a lot because that is what an individual household or an individual person is going to feel. And this is a little bit new for us because we haven't seen this kind of population growth in like 30 or 40 years, if not beyond that.
Mhm.
So kind of disaggregating the two wasn't really a big deal for a long time because population growth was it was positive, but it was pretty slow and pretty steady. And now obviously we're booming on that front. So that's masking quite a bit of underlying weakness, I would say.
That's interesting because, a lot of the people that I speak with certainly feel like we're in a recession. I mean, I think the mood feels recessionary. People are spending less. And it's interesting now that you say that looking at our aggregate GDP could be masking that, given our population boom. So that's interesting. Now, how's, Canada, so Canada's economy has been going sideways, you said, for 6+ months. How have we been performing compared to the US south of the border?
The US honestly looks rock solid. Like we saw I think 4.9% growth, just under 5% growth in the third quarter. The labor market it's still running pretty strong. We're not seeing a lot of sign of really any weakness on that front. Um, Fourth quarter and the first quarter are probably going to look softer. We're already getting some indications that Q4 is probably going to be sub 2%. So back down to something more reasonable. But at this point, they're holding up really well. And I think like there's a pretty big distinction to make there because in one sense we expected this, right? Because Canada, I would think in this cycle is just going to be more rate sensitive,
Mhm.
partly because the mechanics of our mortgage market, like we feel the impact a little bit quicker. Like in the US, everybody during the housing boom, what did they do? They went in locked in for like 30 years, right? So you're not getting the same kind of resets and upward pressure on mortgage payments as one example.
Mhm.
They also have been deleveraging for over a decade in the US
Yeah.
economy, where Canada has been leveraging up in the household sector. So I think it makes sense that we're underperforming here. And yeah, like that's probably something I would expect to continue going forward, which might open up a few uh, cans of worms on its own.
And out of curiosity, yeah, what are those can of worms? I mean, if their economy is almost like ripping, like at 4+% is like a booming economy, and we are underperforming. How does that impact our respective economies, rates? What could we kind of expect from that?
Yeah, so the one thing I would worry about on this is if the US just keeps running, and you're seeing what's happening in the treasury market, right? Where we've priced in higher for longer interest rates and less Fed interest rate relief in the treasury market. That filters into Canada through our bond market and through our yields. And what I would worry about in the next like 6 to 12 months is if we find ourselves in Canada where we're pretty clearly in recession and the US is still humming, the Bank of Canada might get kind of stuck in this awkward place where maybe they can't cut rates as soon as they would like or as aggressively as they would like because the US is still running and the Fed is still holding rates at high levels. And the reason that becomes a problem is the Bank of Canada was going to really depart from what the Fed is doing. You'd have a lot of weakness in the Canadian dollar, which they probably don't want to see, especially in an environment where you still have above target inflation because you get a big decline in the Canadian dollar that at the end of the day, 6, 12 months down the road is again inflationary. So it kind of works against what the Bank of Canada is doing. So the worry would be that we really detach further from the US, but the Bank of Canada can't quite respond as aggressively as they would have in an ordinary cycle because we're still kind of pinned to where US interest rates are.
That's great. And maybe we can unpack that a little bit for everyone who's not a big macro person. So, so what you're saying is if the US continues to boom, and they keep their rates high. Even if we hit a recession, Bank of Canada can't cut, because if they cut interest rates, that will kind of depreciate the Canadian dollar, correct? And that is the side effect. And if the dollar lowers, you mentioned that is inflationary, because goods that we're importing now are more expensive, I'm presuming. Is that kind of the idea?
Yeah, because we're a small open economy, right? And we trade a lot with a much bigger partner. So we would effectively be importing inflation. So think of consumer goods, even like food and grocery prices and things like that, gas prices, very, very
Mhm.
dependent on where the Canadian dollar is going.
Yeah, that's interesting. So, I mean, that's actually a good example, because I think Canadians are just so used to this idea that once we have a recession, the bank's going to cut rates, everything's going to be great again. But I mean, this is just one example you've given us where that might not be the case if the U.S. obviously is booming. Now, speaking of rates, Bank of Canada paused, of course, this month. Now, BMO's forecasts, are you kind of guys expecting that this is it? Like, is this it for the hiking cycle? Are we expecting another one or two increases over the next 6 to 12 months? What's your kind of outlook?
No, no, they're done. They're done raising rates, and I say that confidently. And obviously, we know things can change quickly, but given the information we have right now, they're done raising rates. Um, just the growth numbers we talked about are pretty well confirming to them that the tightening they have in place is enough. Maybe it hasn't been quite long enough to bring inflation down to where they want it, but there's enough tightening in the system to really slow things down. We
Mm.
see it in the growth numbers. You see it in the housing numbers, especially in Ontario. Things are really slowing down.
Yeah.
Um, so that's where we are. Even like some of the other things they look at and put a lot of weight on, like their own business outlook survey.
Mm.
The business outlook survey results have turned pretty quickly in the direction of telling the bank to stop raising rates. And so that's, I mean, you combine all that and we're very comfortable thinking they're done. But that I think the bigger question is, when are they going to actually have the flexibility to start cutting rates? And I think that's probably a story still for well into 2024.
Mm.
And then even beyond that, the even bigger question is, okay, well, where do rates actually go on the other side of this cycle? Are we going to go back to like 1.5 or 2% mortgage rates? We're not going to go there. So
Yeah.
that's the longer term question.
Interesting. Now, Governor Macklem did come out and say that, when they had their most recent announcements, they said that they're prepared to raise the policy rate further if needed. But then I think shortly after that, I mean, and I had people ask me this because they found these contradictory statements where they said that they may cut well before inflation hits 2%. So is that kind of, I mean, does that kind of make sense to you? Would you expect the bank to potentially cut even before they achieve their policy rate target of 2%, or inflation target, I should say?
Yeah, it's possible. Like if economic growth and the job market are clearly breaking down and inflation is really clearly on its way back to target, they might preempt that a little bit. The other thing though is like, so even though we're very comfortable saying the bank is done raising rates, and you mentioned this in their statement saying, we're prepared to move further if we have to, they're gonna talk pretty tough right through the end of this cycle because of some of those factors we talked about earlier, right? Like two things here. Remember what happened back in the spring? The bank first paused what ended up being temporarily, and the market took that as though the bank is done, and
Yeah.
we had a big acceleration in things like housing,
Yeah.
right? And the bank isn't targeting housing or anything like that, but when a very interest sensitive sector of the economy starts to accelerate again, to them it's a sign that, oh, okay, well, policy is not tight enough, right?
Yeah.
So that brought them back off the sideline. So they're gonna avoid that mistake again, and they'll do that by talking tough, even if they themselves probably know they're done raising rates here.
Yeah.
And then the other thing is, they just, like, this is more of a technical thing, but they don't want to adjust market pricing too much relative to what's priced in the Fed because of that Canadian dollar issue we talked about before.
Yeah. Interesting. Now, one thing that they did indicate, one of the reasons for pausing is, I mean, they did indicate a concern about a lot of the upcoming mortgage renewals. And we've seen some, I think RBC posted a report about this. What are you seeing on your side at BMO? I mean, is this something that your team is concerned about, and specifically for viewers, just a lot of the people who have mortgages coming up, who need to renew them at much higher rates, are going to see massive payment increases. Is this something that you're concerned about, both like in terms of if people can afford them, but also, how does this impact the economy if people all of a sudden have to pay an extra $1,000 a month on their mortgage?
Yeah, we're concerned about it. So we don't have any insight into the books or anything like that. But when you look at the pattern of home sales and the Bank of Canada's like lending data through the pandemic, what you find, and the Bank of Canada has actually published this too, what you find is that you have a pretty steady kind of wave of renewals year over year right through 2026. So it's not like we're hitting some like breaking point. This is a pretty steady wave of renewals. And the most stressful part of that comes 2025, 2026, when you have those like 5-year variables that were taken out at 1.5% back at the height of the boom in 2021. And those are some massive payment shocks in this interest rate environment, right?
Mm-hmm.
So I'll say a couple things. I don't think we've set ourselves up for a real crisis type situation where we have like a big wave of delinquencies and defaults, because you have some buffers in place, right? You have 5 years of income growth. You also have the likelihood that by the time we get to 2025, 2026, interest rates are going to have come down the other side of the mountain, at least a little bit.
Mm-hmm.
And everybody's been, in theory, stress tested at 5.25. So they've proven on paper, at least, an ability to handle higher rates.
Mm-hmm.
So that should keep people in their house, right? And the first thing you do is you pay your mortgage. But what's going to suffer is discretionary spending.
Mm-hmm.
Because like, as you say, if those payments are up $500 a month, and that's being polite, probably $1,000, $2,000 a month or whatever for a lot of people, might just mean a few fewer restaurant trips or a few fewer hockey games or less travel or something like that
Yeah.
to balance the book. So I think discretionary spending in Canada is going to be under pressure for some time. So not a big hammer, but like a headwind that blows against discretionary spending for a couple of years.
Yeah. And I think that's kind of the one thing I've been seeing and hearing is the discretionary spending is down. And I think it's probably going to continue to be down, both from, just clients who we speak with, and even business people, I mean, kind of are starting to see it on the ground. So that's going to be super interesting to watch. Now, maybe before we talk about kind of what the next 6 months might look like, because we'll get you to pull out the crystal ball, maybe if you can unpack what you're seeing in Canada's housing market more broadly. I mean, I read one of your recent reports, and it was quite fascinating because, I'm in Toronto. People in Toronto or Southern Ontario think what's going on in the center of universe here is what's going on everywhere. And that's clearly not the case. So maybe if you can kind of at a high level, just walk us through what's going on across the country.
How do you put this simply? So Calgary, Atlantic Canada are steady and fine. British Columbia, Quebec are soft, not great, and Ontario is really not good. So that's kind of the split, and this is right on cue for us, actually. Like, this is right as we expected, because we've done a lot of work on relative valuations across the country and where most of the froth was built up, or where most of the leverage was built up. And it's really Toronto specifically, but also Southern Ontario, like 1 to 3 hours outside the core of the GTA, that were the most just really overblown with respect to the amount of froth that built up in housing through the pandemic. So that's where the biggest adjustment is, and pretty clearly that's what we're seeing on the ground right now. Like, even in the Toronto numbers, and you probably have all these numbers in real time, or as we get them at the end of the month, but we haven't seen this level of inventory in like a decade. We haven't seen this the market balance this soft since like 2008. So it's weighing pretty hard on us here.
Yeah.
Calgary, and I was just in Atlantic Canada yesterday, and the market there is it's not running, but it's not breaking at all. It's very steady and very flat.
Which is very somewhat fascinating, because there's still obviously Canadians who are buying homes and are getting stress tested at, whatever it is now, like 8+%, 8.5%, whatever they're getting stress tested at. And one would think that demand would be plummeting across the country. But I guess what we're seeing is when house prices are, obviously not 10 times incomes the way they are in Toronto, where they're significantly less. I mean, I guess is that kind of what is driving those markets specifically, that they're just, even at a stress test of 8.5%, people can afford it because prices are significantly lower.
That's part of it. Like, even just look at relative affordability. Like, why is Calgary so attractive? So there's like 40 or 50,000 people per year moving into Alberta from other provinces in Canada, mostly Ontario.
Mhm.
Um, in the past, you would make that move to find a job or to find a better paying job. And now you're moving for affordability because the job markets are tight across the country. So you're moving out of Ontario to a province like Alberta, maybe with some equity in your pocket and house prices that are a fraction of what they are in the GTA.
Mhm.
So it's enough to keep that market well supported. And like as I said, prices aren't running at a double digit rate like they were, but they're not cracking either. There's fundamental support there. And a
Mhm.
market like Calgary was like, remember pre-COVID, before interest rates were cut and this housing boom was set off, Calgary was in the dumps for like 5 years after oil prices fell. So
Mhm.
there was a lot of just year after year relative affordability and attractiveness building in that market. And now it's playing catch up.
Interesting. That's super interesting to hear that how different the markets are behaving across Canada. So maybe as we move forward now, to kind of get your thoughts on, what the next, maybe whatever it is, 6 months or so looks like. And maybe again, we'll kind of kick off with the broader macro look. And is BMO, I guess, expecting us to go to a recession? Before we kind of talk about that, maybe if you can unpack for some of the people who just are not even clear, like the technical definition of a recession for the average person who maybe doesn't know what that means, if you can kind of unpack that.
So, so funny. Somebody asked me, like, I was doing a speech to a group the other day, and somebody asked me, "How are we going to know when we're in recession? What data do we have to look at?" And I said, "You'll know when you're in a recession because everything's going to feel pretty crappy around you, right? Maybe
Mhm.
friends are losing jobs and you're spending less and stuff like that." But um, no, so like the academics that mark these things will look at they'll look at usually like the three Ds, they'll call it, right? The depth, duration, and dispersion of basically how bad things are getting. So
Mhm.
the depth, like if GDP falls a little bit for a quarter or two, it might not be necessarily a recession.
Mhm.
The duration is typically they're looking for at least 2 quarters of weakness, right? So if you have a temporary 1 quarter decline in output in the economy, they're not going to call that a recession.
Mhm.
And then the dispersion is probably like the important one, because if you have a situation where like one part of the country is underwater, like say Alberta in 2015, where
Mhm.
the rest of the country is still growing, they're not going to call that a recession. And we experienced exactly that in 2015.
Mhm.
Or if you have just like one sector of the economy that's contracting where a number of others are still growing, you're not going to call that a recession. So like think of the number of homes we're building right now,
Yeah.
and things like that. That it's not a recession yet by like the academic standard, right? But so where we go in the next 6 months, I mean, we're not technically forecasting something that would meet those criteria. We
Mhm.
have basically zero growth in our forecast through about the middle of 2014.
Mhm.
And I would just say like that a pretty polite way of saying there's risk out there that things are going to be pretty tough for the next little while. We could very well call it 50-50 if you want, meet that technical criteria of us being in a recession.
Okay, so 50-50, that we actually might be negative GDP growth sort of at the aggregate over the next kind of 6+ months. Is that what you mean?
Yeah, like I would say it's probably even better odds than that. But like again, a couple quarters of negative GDP growth might not be enough to actually feel or meet the technical definition of recession. For it to actually like get bad enough where people feel it, there's some job loss and things like that, I would say, yeah, you're getting probably pretty close to those odds. I would say almost like pretty good high chance we get a couple negative quarters for sure. We've already seen a few
Mhm.
small negatives on the ground.
Okay, that's interesting. Now, I think again, I mentioned earlier, I think most, the most people kind of who hear recession or think that we might be going to a recession, their immediate, expectation is that rates are going to get cut, because somehow they've learned that when we go to a recession, Bank of Canada cuts rates. So you gave us one example of why the bank may not cut rates, for example, if the US is still keeping rates elevated. Would another example would be, I mean, what happens if inflation stays high? I mean, is it a given that if we hit a recession that rates are going to be cut by the Bank of Canada, I guess is the main question.
So I think they probably would.
Mm-hmm.
They might not fall as much as we have seen in past cycles, or as much as a lot of people might be hoping for.
Mm-hmm.
And I think like rooted in all of that is the reality that the neutral level of rates is just higher now
Mm-hmm.
than it has been. So everybody's talking about higher for longer, right? But it's not really higher for longer. It's more like we're going back to normal. And the last 10 or 12 years was the exception.
Mm-hmm.
So like COVID was obviously an exception where rates were cut to zero, but even post financial crisis in that 10 to 12 year period, think of all the things that were going on. The Fed was out there aggressively buying treasuries through quantitative easing. You had foreign countries buying treasuries. Both of those, the Fed and countries like China, are now sellers. So that's pushing rates up.
Mm-hmm.
You had a lot of disinflationary pressure coming from globalization.
Mm-hmm.
We've kind of turned the other way now.
Mm-hmm.
So we're reshoring a lot, and the shift towards um, cleaner energy. That's all incrementally inflationary.
Mm-hmm.
And you also had like a household in the US deleveraging for a decade, which was kind of causing policymakers to like push on a string, which suppressed interest rates too. So that's also over now. So all of those factors that were holding rates down are now gone. We're resetting back to a world for interest rates that's just more normal now. And like so for real world context, um, Bank of Canada policy rates through that decade would have been like 1% on average. Maybe they're going to get back to like 3% now, 275 or 3 as neutral. And
Interesting.
mortgage rates, maybe that means like 4% as neutral now. So we're going to come down, but we're not going to probably come down as far as people think. And I
That's
know that's a long answer, but
yeah.
that's kind of how we
No, that's
frame it
great.
all.
And so before I had a few questions about that. Before we go down that road, one thing I wanted to ask you is if you think there is a risk of us getting into this, stagflation environment where the economy's weak, inflation's still hot, then what does the bank do in that scenario? If the inflationary indicators are not coming down, but our economy's terrible, are they still cutting? Is it modest cuts, or are they still staying high? I mean, obviously we don't know, but what would you expect, I guess?
Yeah, I'd expect just weak growth and still high rates. And like look at the last 6 months. There's been no growth in Canadian GDP, and we've had very restrictive policy rates. So you can call that stagflationary if you want, right?
Mm-hmm.
Even real per capita spending has been down over that period.
Mm-hmm.
So that's it. And you're right. It's the inflation backdrop that ultimately dictates what the Bank of Canada and the Fed can do. And like there's been encouraging progress on that front.
Mm-hmm.
Like core inflation in Canada, if you look 3 month annualized, which is what we should be looking at, not what happened a year ago. You can call it like 2.5 to 3.5% as the run rate right now, depending on what measure you look at.
Mm-hmm.
And the Bank of Canada likes to confuse everybody by publishing like 5 or 6 different measures of core inflation, right? But that's roughly what the underlying run rate of inflation is.
Mm-hmm.
So they haven't quite cracked it yet, but we're seeing signs that we're almost there. And like and this is where it kind of gets tough for the economy, because the bank is trying to thread this needle very carefully, right? Where they have to raise rates and keep them here long enough to break down inflation, but they don't want to keep them here so long as to really break the economy.
Mhm.
And they have to, and this is really hard to pull off historically, right? Like this is why you have economic cycles, because it's so
Yeah.
hard to pull off. And if they're going to miss this in one direction, they're going to miss it by leaving rates too high
Mhm.
to make sure they break inflation at the expense of the economy. That's the trade they're going to have to make.
So do you think what is you think it is a real risk that they break the economy? I mean, that's not in most people's forecasts right now. And by breaking the economy, I mean, I'm assuming you mean like a deeper recession than most are predicting, correct?
Yeah, an actual legitimate recession, which is not what the bank has in their forecast. It's not what we have on paper either. But
Hmm.
it's a risk for sure.
Hmm. Interesting. So one thing that I wanted to ask you is, okay, so we talked about the bank, I mean, potentially cutting rates, if the economy softens, obviously not as aggressively as maybe some people would hope. But one question we got was, would we expect, for example, so I mean, variable rate mortgages, of course, set by whatever the Bank of Canada is doing. Fixed rate mortgages are based on what's going on in the bond market. So, would we expect to see bond yields and by extension, for example, 5-year mortgage rates fall more or before what the Bank of Canada does? So is the bond market moving before the bank, or how would we expect that relationship to play out?
Yeah, typically you would see that, right? Typically you would see the long end rally in advance.
Mhm.
You see like the 2-year rally in advance of rate cuts. The market's pretty smart, right? The market will discount it and price it ahead. And we've seen a few false starts actually. Like look at what happened in the spring. What we saw in the spring was the bond market, mostly in the US, but Canada piggybacked it, pricing in rate cuts in the second half of this year when we went through that kind of mini banking crisis, right?
Mhm.
So that was the market's way of pulling down medium and long-term interest rates, expecting rate cuts. Now that didn't play out obviously because the economy held up well and inflation was still sticky.
Mhm.
But what we saw is exactly what you described, where 2 and 3 year fixed mortgage rates in Canada really fell through the spring, and we had like 4.5 to 5% on those mortgage rates, and that helped juice the market through the spring until reality set in that no, we're not actually getting rate cuts, and then everything got priced back out.
Yeah.
So that's typically what you would see.
Yeah, that's interesting. And this is of course important because you're right. I mean, that's actually what's been crushing the market. I mean, we had 4.5, high fours mortgage rates, 4 or 5 months ago, and now we're in the sixes, which is just mind blowing. This kind of 180 we've done. So based on that, I mean, and all of that, what is your broad outlook for housing in Canada in 2024? I mean, what is BMO expecting how this might play out and how high rates might kind of unfold and kind of flow through the housing market?
Yeah, I think it's going to be tough. Unfortunately, that's the reality. There's going to be some regional variation. We talked about that. Different segments of the market are going to feel it a little bit differently, like single detached in prime areas versus say condos in a non-prime area in Toronto. That's going to probably be a big difference too.
And
But it
which one are you expecting to be hit harder, the low rise or the condos?
Oh, the
Okay.
condos, yeah, because we have a pretty big pipeline that's coming to completion, and I frankly think a lot of that was bought up and projects started without the intention to close or really live in. A lot of that was investor demand that just doesn't make a whole lot of sense right now, right?
Mhm.
Like think of a pre-con buyer in 2021 that's going to come to completion in a world where uh, the resale market's just not there for that person to flip without a loss, or the rental market is there, but yeah, does it make sense to hold something at a 6% cost of borrowing versus 1.5? From a cash flow perspective, it might not. So I think a lot of that's going to spill onto the resale market
Mhm.
as it comes to completion.
Interesting.
But yeah, but like big picture is that I mean, it's not hard. We had an asset price that was really stretched from a valuation perspective, and it was really stretched when mortgage rates are 1.5%. And we've
Mhm.
raised rates 475 basis points in a short period of time.
Mhm.
there's going to be a fallout from that, and the fallout is that the price of the asset has to adjust, and it's adjusting down as you know, as we speak.
Yeah. Interesting. So, I mean, so you're looking at downward pressure on the condo market, potentially even low-rise market, and I'm guessing that you still think that the trends that you kind of talked about earlier nationally are probably going to play out, where Southern Ontario gets hit a little bit harder than than Atlantic Canada or Calgary, for example.
Yeah, I think that's right. I think that's how it plays out. Um, yeah, and like from a longer term perspective too, I mean, question we get a lot, well, like what about all the immigration and demographic demand? Is that going to support the market? Like it will, but uh like think of the last like decade or so that kind of culminated during the pandemic, where interest rates fell to record lows, demographic demand from the millennials rose to right about now where it has peaked, and international immigration flows rose to a level that where we've probably seen it peak. We can't replicate those conditions that we've seen over the last 10 years going
Hmm.
forward over the next 10.
Hmm.
Like we can't beat that. So incrementally, the path for house prices is going to be a lot softer than that, because those those are like three major factors that came together at one time to push prices up that we can't replicate.
But what we are we going to replicate the population boom? I mean, the immigration minister said they're increasing to 500,000, and if we add the not 500,000 immigrants plus however many, probably 500,000 plus of non-permanent residents. So to what extent, or how does this sort of, like you said, 3% population growth, how does that transmit through the economy? Is that going to support one sector or segment more than another? And I don't know what that is. I mean, I'm just like rentals or some regions, because at the end of the day, people still need a place to live, right? So how do we
Yeah.
see that playing out?
Yeah, so we kind of get in this situation where we have a cyclical aspect that we're going through now,
Hmm.
um, higher rates and adjusting the asset price to reflect this normal interest rate environment. So that's underway, but we come out the other side, and it could very well be a little bit under supplied still, right? Because like what's happening now, construction activity is actually down year
Hmm.
over year. I mean, policymakers say we want to double or triple it, which is in a perfect environment was never going to happen. But now we have a much tougher demand environment. It's clearly not going to happen. So we come out the other side of this, out of this cycle where we kind of are struggling with the supply demand balance. I think that's fair.
Hmm.
But two things also kind of working against this story are, one, the millennial group, which doesn't get nearly enough appreciation in this whole 10, 20-year bull market in housing.
Hmm.
They're peaking right now, right? Peak millennial right now is about 32 years old.
Hmm.
So as we go forward over the next 10 years, that wave of demand is going to kind of play itself out.
Hmm.
And the other part of this is I personally think that there's a realization now that the demand curve actually matters in housing, unlike the last couple years. And it's the curve that's a lot easier to adjust. And we're seeing, even just from the government now with those immigration targets and some chatter about looking at the amount of non-permanent resident flows coming into country. I think there's an appetite out there to say, hang on, okay, what's the right setting here? Obviously, the setting we have now is not something we can meet from a supply and an infrastructure perspective. So maybe that gets actually dampened down a little bit going forward. So the flow will still be high, but maybe the tap gets turned down a little bit going forward.
I see. That's helpful. One question I had, I mean, and I wanted to ask, is you kind of touched on it, and it was in your report, or one of your reports, when you're talking about sort of cap rates on investment properties, in an environment where, interest rates, the new normal is not 2% or 3%, but it is, 4.5% on a mortgage. How is that playing out on rental properties? I mean, especially, when cap rates are, and cap rates, for people who just don't know, are just really just the kind of the return on the rental income based on the value of the property. Think of it like as the interest income. This is your net rental income of 3+%. How does that play out? I mean, are we going to see I mean, I think one thing he said, prices are just going to dip to kind of improve the cap rates. And is that just because investors are going to just hit pause and not buy them? And so how do you see that kind of playing out, the investment market, just given in a high rate environment where returns are so low?
Yeah, like correct me if I'm wrong, but I don't think investors are buying anything right now.
Mm-hmm.
Uh, and the multifamily, at least, the stuff I track is just not moving at all.
Mm-hmm.
And um, like again, this is not that complicated, right? If something made sense when mortgage rates were 1.5%, let's say, okay, we had like a 3.5 or 4% cap rate on a property in Toronto, that was pretty highly valued, but at 1.5% mortgage rates, maybe you could kind of justify it from a cash flow perspective. If not even from a cash flow perspective, then the perspective that below the surface you are paying down a lot of debt and building equity.
Mm-hmm.
But if you very quickly reset that to 5 or 6%, if not more, you're deeply cash flow negative every month. You're not building any equity every month. And all of a sudden, in these market conditions, you're not able to count on the fact that the actual price of the asset is rising either. So it doesn't make a whole lot of sense. And then for the first time in also like 10 or 20 years, you can sit there and, okay, I have a down payment. I can park it in risk-free GICs at 5% plus. Why am I going to go out and buy an asset at 3%
Yeah.
that has no liquidity? Prices are falling and has a lot of market and regulatory risk, not to mention the landlord tenant board. And I
Yeah.
can just stick money in GIC and go to sleep at 5%.
Yeah.
So I think that adjustment is going on, and cap rates can adjust through rents too. Obviously, the rental market's very strong and rents are growing, but it's going to take time to just rebalance all that through some combination of higher rents and lower prices.
Yeah, I mean, you touched on a lot, and I do wonder to what extent are we going to see a massive pivot? I mean, again, if prices are flat, even the condo market's not looking good at rates that are 4 or 5%. I mean, and if you see a lot less investment in it, how's that all going to play out? I think is going to be a pretty important kind of thing to keep an eye on. So that's super helpful. Before we wrap up, I thought do you have anything else that you thought would be worth touching on that I didn't ask you?
No, I think we covered most of it, I would think there. Yeah. You never really know, right? Like we've been surprised a lot the last couple of years, and then in some respects we haven't been surprised at all with some of how this is
Mhm.
played out. Like we were pretty early on the inflation call. That's all kind of played out. And I think it's kind of touched on this before, but I think it's interesting now that policymakers too have realized, hey, there's a demand curve in housing too. and and after jumping up and down and saying we need to build more for the last 2 or 3 years. I talked to builders, they can't build anymore.
Yeah.
So the demand curve is where they're going to probably be pushing on now. So I would say like some things to watch for beyond the Bank of Canada on the demand side, which obviously is the big factor.
Mhm.
Um, if there are any further tweaks to immigration policy, especially non-permanent residents, that's something to be mindful of.
Mhm.
And even in the fiscal update we're going to get in a couple weeks, if not the budget next spring, probably some other demand side measures on housing as well to keep an eye out for.
Yeah, it does sound like that's what they have in the pipeline. So that'll be interesting. Awesome. Well, thanks so much for taking some time today to chat with us. Learned a lot, and I think our viewers probably going to learn a lot about sort of what to look for in the next 6 months or so.
All right, awesome. Thanks for having me.